Hey everyone, welcome back to Tesla Daily. Today is March 17th, 2026, and we've got a lot to talk about. First up, we're diving into Tesla's new insurance partnership with Lemonade. This is an exciting move that could really shake things up in the industry. Then, we'll explore that massive $4.3 billion battery deal. That's a big step for Tesla, and could have a huge impact on our future. We'll also touch on Tesla's energy expansion. It's great to see the company pushing boundaries in renewable energy. And let's not forget about the Robotaxi expansion. This is a game changer for our transportation landscape. But it's not all smooth sailing. We'll discuss some of the challenges Tesla is facing during this transition. It's important to stay realistic about setbacks, but we're optimistic about the long-term outlook. Before we jump into all that, let's take a quick look at the stock. Let's take a quick look at Tesla's stock performance. As of March 17th, 2026, it closed at $399.27. That's a nice little bump, up about 0.90% for the day. It's always good to see our favorite company making some positive moves in the market. In a bold move to solidify its position as a leader in artificial intelligence, Tesla is embarking on the Terafab project, which aims to establish a chip factory to meet the growing computational demands of its AI initiatives. Elon Musk has indicated that this project is crucial to prevent a potential bottleneck in AI compute capabilities expected within the next few years. However, analysts warn that building such a facility could be a Herculean task, requiring an estimated capital investment of $35 billion to $45 billion. Significantly exceeding Tesla's projected capital expenditures of $20 billion for 2026. Musk's vision extends beyond just vehicle manufacturing. He envisions a future where Tesla not only sells electric vehicles, but also offers advanced AI. Next up, another key development. In a significant and distressing development, 3 teenage girls from Tennessee have filed a class action lawsuit against Elon Musk's artificial intelligence company, xAI, alleging that its Grok chatbot was used to create and distribute child sexual abuse material, CSAM. The lawsuit, filed in the U.S. Northern District of California, claims that Grok's capabilities were exploited to digitally alter images of the minors, transforming them into sexually explicit content without their consent. This troubling case highlights the potential dangers of AI technology when not properly regulated. The plaintiffs assert that Grok's Spicy Mode feature allowed users to undress individuals in photographs, leading to the creation of nude images that were subsequently shared on platforms like Discord and Telegram. According to the Here's the Next Update You Should Know, Tesla is on the brink of a major expansion of its Robotaxi service, with plans to launch in new cities like Las Vegas and Dallas. Recent sightings of Tesla Model Y vehicles equipped with rear camera washers exclusive to Robotaxi models indicate that the company is preparing to scale its autonomous ride-hailing operations beyond its current markets of Austin and San Francisco. According to reports, Tesla has confirmed ambitions to introduce its Robotaxi service in 5 new U.S. cities by mid-2026, including Phoenix, Houston, Miami, and Orlando. BofA Securities recently initiated coverage of Tesla with a buy rating and a price target of $460, highlighting the company's leadership in autonomous driving technology. They estimate that robotaxis could account for approximately 52% of Tesla's market value, emphasizing the potential of this segment as a major growth driver. The firm also values Tesla's Optimus humanoid division at over $30 billion, reflecting the company's broad vision for automation. However, competition is fierce. Former Uber CEO Travis Kalanick noted that Waymo currently leads the robotaxi race, citing their operational scale and urgency. Kalanick remarked, "Waymo obviously is ahead. The existence proof is there," indicating that while Tesla has the technical fundamentals, it faces a challenging timeline to catch up. Tesla's approach relies on a camera-only system, which is cheaper but technically more complex than the multi-sensor systems used by competitors. Despite these challenges, the upcoming launch of the Cybercab, designed with advanced features including multiple camera washers, signals Tesla's commitment to advancing its autonomous capabilities. The company is also actively preparing for volume production of this vehicle, which is expected to further enhance its robotaxi fleet. In summary, while Tesla's ambitious plans for its robotaxi service are promising, the road ahead is fraught with competition and technical hurdles. The next few months will be critical as we observe how Tesla navigates these challenges and whether it can establish a foothold in new markets while competing against established players like Waymo. Next up, another key development. Tesla is currently facing significant challenges in its core automotive business, with vehicle deliveries declining 9% year-over-year in 2025, totaling approximately 1.64 million units. This decline is compounded by increased competition, particularly from Chinese rival BYD, which has recently overtaken Tesla in global EV sales. In response to these pressures, Tesla has announced it will discontinue production of the Model S and X models during the second quarter of 2026, a move that some analysts are framing as an honorable discharge due to the natural obsolescence of these vehicles. The Model S and X served their purpose and are now outdated on a number of different levels, noted industry experts. Despite these setbacks, Tesla is not standing still. The company is doubling its capital expenditures and is shifting its focus towards its ambitious robotics and AI initiatives. CEO Elon Musk has indicated that Tesla's future may heavily rely on its development of autonomous vehicles and robotics, specifically the Optimus humanoid robot. This transition is seen as a strategic pivot, with the potential to redefine Tesla's market position. In fact, Cathie Wood, a well-known investor, has projected a price target of $2,600 for Tesla by 2029, largely based on the anticipated success of its robotaxi program, which Musk claims could operate in 25% to 50% of major U.S. cities by year-end. Tesla's energy sector is also showing promise, with energy revenue climbing 27% year-over-year to nearly $12.8 billion, helping to offset some of the automotive revenue decline. Overall, total company revenue for 2025 was $94.8 billion, down just 3% from the previous year. However, profits are moving in the wrong direction, with non-GAAP net income falling 26% year-over-year to approximately $5.9 billion. In summary, while Tesla faces immediate challenges in vehicle production and market share, its strategic pivot towards AI and robotics could provide a new growth avenue. The long-term outlook remains cautiously optimistic as the company seeks to redefine itself in a rapidly evolving landscape. Next up, another key development. In a landmark move, Tesla has secured a $4.3 billion agreement with LG Energy Solution to establish a lithium iron phosphate (LFP) battery cell manufacturing facility in Lansing, Michigan. This partnership is set to bolster Tesla's energy storage capabilities, particularly for its Megapack 3 systems, which are crucial for utility-scale energy storage. Production at the new facility is expected to commence in 2027, marking a significant step in Tesla's strategy to localize its supply chain and reduce reliance on foreign battery imports. The Lansing plant, originally designed to supply batteries for General Motors, has pivoted towards energy storage solutions amid shifting market demands. This transition is indicative of a broader trend where companies are adapting to the increasing need for energy storage solutions, especially as the demand for electric vehicles (EVs) fluctuates. As Bob Trezies, president and CEO of the Lansing Economic Area Partnership, noted, today's announcement is proof that Michigan is and will continue to be the premier state in the battery production landscape. Tesla's energy division has been experiencing remarkable growth, with nearly $12.8 billion in revenue reported in 2025, reflecting a 26.6% year-over-year increase. The company's focus on energy storage is not just a side venture. It represents a core component of its future business model. CFO Vaibhav Taneja emphasized this shift, stating, "As we look at 2026, our backlog remains strong, well-diversified globally, and we expect increasing deployments with the launch of Megapack 3 and Megablock." This $4.3 billion investment is not merely about expanding production capacity. It signifies Tesla's commitment to enhancing its domestic manufacturing footprint and securing a competitive edge in the energy market. By producing batteries in the U.S., Tesla can capitalize on federal incentives aimed at promoting clean energy manufacturing, which is critical in the current economic climate. In conclusion, while the automotive sector faces challenges, Tesla's strategic pivot towards energy storage and domestic battery production positions it well for future growth. The partnership with LG Energy Solution is a clear indication that Tesla is not just a car manufacturer, but is evolving into a comprehensive energy solutions provider. As we move forward, this development could redefine Tesla's market presence and influence in the energy sector significantly. Now let's shift to the next story. In a notable development for Tesla's energy segment, we have secured a monumental agreement to purchase $4.3 billion worth of battery cells from LG Energy Solution, which will be produced at a facility in Lansing, Michigan. This plant, initially intended for a joint venture with General Motors, has been repurposed to support Tesla's growing energy storage needs. This deal underscores our commitment to expanding our energy business, which saw a remarkable 27% revenue increase last year, totaling $12.8 billion and accounting for 13% of our overall revenue. However, the automotive side of our business is facing headwinds. Reports indicate a 10% decline in vehicle revenue, prompting us to adapt our strategies. CEO Elon Musk has expressed optimism about the energy segment, stating it is expected to experience very high growth for as far into the future as we can imagine. Yet, CFO Vaibhav Taneja cautioned about potential margin compression due to increasing competition from low-cost rivals. In another significant move, Samsung Electronics announced plans to begin mass production of computer chips for Tesla vehicles at its Texas facility, with production set to start in late 2025. This collaboration aims to bolster our technological capabilities, particularly in the realm of automation and artificial intelligence, which are critical to our full self-driving FSD initiatives. Despite these advancements, we must also acknowledge the challenges ahead. The automotive market is becoming increasingly competitive, and while our energy business is thriving, it may not fully offset the declines in vehicle sales. The transition to a more diversified business model, focusing on energy and AI, is essential for our long-term sustainability. We remain committed to innovation and growth, with a clear vision for the future. As we continue to enhance our energy solutions and technological infrastructure, we believe that our strategic partnerships and investments will position us favorably in the evolving landscape of electric vehicles and renewable energy. In a significant development for both Tesla and the insurance sector, Morgan Stanley has upgraded Lemonade Inc. to overweight from equal weight, citing the company's promising partnership with Tesla. This collaboration allows Lemonade to offer a remarkable 50% discount on auto insurance for Tesla owners utilizing full self-driving FSD technology. According to analyst Bob Jian Huang, this partnership not only gives Lemonade a first-mover advantage in the emerging autonomous vehicle insurance market, but also positions the company for substantial growth. As the auto market continues to evolve toward autonomy, we expect Lemonade to expand its autonomous exposure geographically, putting it on the path to 10x its business, Huang stated. This upgrade comes at a time when Lemonade's stock has shown volatility, plunging 19% this year, but surging 56% over the past 12 months. Currently trading at around $57.74, the stock has a price target of $85, reflecting Morgan Stanley's optimistic outlook. The firm believes that as autonomous vehicles become more prevalent, Lemonade's innovative insurance model will allow it to capture a significant share of the market. Lemonade's recent financial performance also supports this optimistic view. In its fourth quarter 2025 earnings report, the company exceeded expectations with a narrower-than-expected loss per share of -29 cents, compared to the forecasted -39 cents, and revenue of $228 million, surpassing the anticipated $216.26 million. These results highlight Lemonade's ability to adapt and thrive in a rapidly changing market. As Tesla continues to lead the charge in autonomous driving technology, this partnership not only enhances Lemonade's competitive positioning, but also signals a shift in how auto insurance will be underwritten in the future. With the automotive landscape evolving, we can expect Lemonade to leverage its partnership with Tesla to redefine insurance norms, potentially setting new standards in the industry. In a significant development, Tesla CEO Elon Musk is currently in discussions with the U.S. Securities and Exchange Commission, SEC, to settle a lawsuit regarding his delayed disclosure of Twitter share purchases. The SEC alleges that Musk violated securities laws by failing to disclose his initial 5% stake in Twitter within the required timeframe, allowing him to acquire shares at artificially low prices. The lawsuit, filed in January 2025, claims Musk's 11-day delay enabled him to save approximately $150 million at the expense of other investors. Both parties have requested an extension until April 1st to propose a schedule for further proceedings, suggesting a potential resolution may be on the horizon.